Testing. Perfect. Okay. Good morning. Bonjour. Welcome to this session on impact and institutional investors. My name is Tim Raji, the founder of Alpha Mundi Group. And I thought I would provide a little bit of background on the rationale for this session and the agenda of this session. So thank you for being here. We have about 90 minutes and a roster of great speakers. We have Myriam Garçon from the Global Impact Investing Network, the representative of the GIN in Switzerland. We have Greg Haney from CPEG, that's the Geneva Public Pension Fund. We have Joachim Ruiz from the EIF, head of secondaries at EIF. Thank you for making the journey to Geneva today. And we will also have Vincent Kaufmann from the Ethos Foundation and Services to represent the broader perspective of Swiss pension funds and sustainability. Before we dive into the individual presentations and the panel, and please rest assured that we will make time for a dialogue with the audience for at least the last 20 minutes of the session. I wanted to share maybe an update from Alpha Mundi and why Alpha Mundi is present here. Alpha Mundi is a group I founded about 12 years ago. We've invested more than $100 million in impact SMEs, mostly in Africa and Latin America. We've used different instruments to do so, private equity, mezzanine, debt. We also have a corporate foundation that deploys grants for loan guarantees, for gender empowerment, and for business innovation. Now, through our activities over the last decade, we've been fortunate to enjoy a number of public-private partnerships. Our debt fund, Social Alpha in Luxembourg, has a guarantee, a portfolio-level guarantee for loan losses from the American and the Swedish development agencies. And our foundation has enjoyed collaborations with Canada, with Germany, and other countries with regards to its activities for development in emerging markets. And so I think at Alpha Mundi, we're very fortunate to be well positioned to understand the value of a private-public partnership and also how complex it is to set up such PPPs, but how necessary they are for the growth of the market. And this is one of the core topics of the session today. It's the emerging collaboration between the European Investment Fund, which is a public sector agency well known for its investments in private equity funds and impact funds in Europe, and with CPEG, which is really, in fact, leading an increasing consortium of institutional investors interested in the project. And thank you, all of you, for your leadership in this field. Maybe also a quick comment summarizing what we've observed from the last 2 days of building bridges, and my thanks to Sustainable Finance Geneva for putting together such an interesting program of sessions. The first one is that the price of inaction is increasing. When the Sustainable Development Goals were launched, the United Nations estimated that we needed about $2.5 trillion per year of financing to transition from a traditional to a sustainable economy. Today, that number is 4 trillion. And the difference is the result of inaction, right? We all know that governments and the corporate sector have understood the urgency. They have signed the Paris agreements. Many of them have enacted policies for sustainable finance. But by and large, we haven't done enough. We haven't done it well enough and fast enough and big enough. And so the price of these delays and that inaction is increasing every day that we look at the news, and we see climate change is now in a 2.5 degree scenario, and nobody thinks that we can revert back to the less than 2 degrees increase. We've got plastic pollution, and yesterday at an event led by Credit Suisse at the World Economic Forum with Klaus Schwab, with the leadership of Credit Suisse, with Andre Hoffmann, we heard that we are in crisis. And it seems that some regulators and some corporates are not getting the message. And so one of the key contributions that the financial industry can bring to this dramatic equation of the transition to sustainability or the death of ecosystems is finance. And we need to understand the hurdles that are preventing institutional investors from deploying more capital with impact. In Switzerland, based on the latest June survey of Swiss Sustainable Finance, we know that about 100 billion Swiss francs have been invested out of more than 8 trillion Swiss francs that we manage in Switzerland. So we can see that in Switzerland, which is one of the most advanced markets for impact investing and sustainable finance in terms of sophistication, history, product range, we've only mobilized about 1% of our capital for investments with a measurable impact. And this needs to change and change quickly. And that's the purpose of our session today. How can institutional investors step into impact investing with the comfort of achieving their risk-adjusted returns, satisfying their fiduciary duty. And by the way, I think increasingly we're seeing an expansion of the definition of fiduciary duty. It's no longer about short-term profit maximization. It's no longer about even the market benchmark in a way. If we look at the European SFDR, the Sustainable Finance Disclosure Requirements, we can see that the regulators understand that fiduciary duty today is about integrating sustainability risks in your long-term strategies and your portfolio allocation. In Europe, this is becoming compulsory very quickly for all of the asset managers operating in Europe. In Switzerland, I believe there are not many constraints from the regulator for institutional investors to invest with impact. Maybe something to consider as well. So without further ado, I will give the floor to Miriam Garçon, who will present us with a perspective from the GIN, the Global Impact Investing Network, on the role of institutional investors in impact. Miriam, thank you so much.
Thank you, Tim, for the introduction, and a warm welcome from my side. I'd just like to start with telling you a little bit who the GIN is, because some of you might not be familiar with the organization. So the GIN is a network of a little bit of over 400 organizations who are practicing impact investing. And these are specialized impact asset managers, banks, institutional investors like pension funds and foundations or family offices, as well as development finance institutions. The GIN's mission is to make impact investing available to everyone, taking financial decisions, and therefore elaborates definitions and tools which are broadly used and accepted. In this context, we have been running a series of workshops with institutional asset owners globally, about 25 pension funds and insurance companies from all over the world who are somehow involved in impact investing. And the goal was actually, or is still, they're still running, the goal is to find out what motivates them to include an impact investing approach in their processes, how they do it, what kind of obstacles they face, and what kind of solutions they meet. And there is a couple of findings I'd like to share with you to start this session with. And I can tell you very simply that one of the findings is, it's not going to be all, but no one of these pension funds or insurance companies would say they do impact investing. They actually do it, but they call it differently. So that's maybe just one obstacle is linked to the expression of impact investing. However, they all somehow think they do real impact or real world impact in some way, but they call it differently. Another finding, basically a common finding, is that no one of them has fully integrated an impact investing approach in a perfect way. So I say this because it's a long journey and there are various ways of how to start and how to go about it. And I think today's session will give you some inspiration about what this could look like and potential solutions for that. But everyone still thinks that actually including an impact investing approach is very beneficial for several reasons. One clearly is to generate real-world impact in some way or the other. It can be connected to an environmental goal or social goal or a combination. It's also, they think, very beneficial for their communication, depending, like communication to their employees or communication to other stakeholders like customers, or even within the company, to the board, to the employees, etc. And the third major point is that they think it's very helpful to make informed decisions, informed investment decisions, because it just adds another level of information to how they can deploy their money. So that's a very short summary, and but I like to give you a little bit more insight and start with so just that we have a bit of a common definition. I like to share the definition of the GIN of what impact investment is. So impact investments are investments made with the intention to generate measurable positive social and environmental impact alongside a financial return. So such investments can actually be made both in emerging and developed markets and throughout all asset classes. And as it says, it's alongside a financial return that is most of the time a market rate return, but it can also be concessional. And I'd also like to share the core characteristics of impact investing, which I think help to add a little bit more clarity to this definition. And so it's about the intentionality. So an investor makes a choice to pursue a certain impact goal, to solve a certain problem. So it's this intentionality of achieving something. The second point is to use evidence. So when defining an impact strategy, one should actually use some scientific evidence material that underline actually the fact that the strategy one chooses actually should or is supposed to lead to the goal one wants to achieve. And today, I mean, after a couple of decades already of impact investing, there is quite a lot of such evidence material available. And the third point, very important, is actually the management and measurement of the performance. It's not only about the measurement, actually, but especially also managing managing the investments according to the findings. So depending on how far one is in achieving the goals, one should take this decision or another. It can also be if the goals are achieved, then one decides to divest and actually go for another investment decision that actually supports the achievement of the goals. So that was really in brief, and I think what it helps maybe here is to understand there is still a lot of confusion about what is ESG and impact and how does it overlap. And I think this makes it pretty clear that ESG is actually, maybe simplified, but it's more about looking at the risk of the investments. It just adds more information about ESG risks and informs the decision as such. With impact, it's an intention to change something, which is not given by a proper ESG approach. However, ESG considerations are supposed to be integrated in impact investing, so because one doesn't want to do harm by achieving a positive goal. And another, I think, important factor is the measurement and management of impact. Again, with ESG, it's usually a collection of KPIs one uses before the investment, also maybe in the course of the investments to do the controlling. But with the measurement of impact, one wants to see the progress, like this gap that one wants to close should actually close over time, and I think that's not given in ESG. So that was really to maybe set a little bit the floor. And then I'd like to share just a few points on the, let's say, on the different stages of implementing an impact approach before then maybe giving my colleagues the stage to give some more practical insight. But what we found actually when we discussed with this asset owners group, that setting impact goals was already a challenge by itself, in the sense that one needs to define a theme. And there are various ways of finding or identifying the theme. It can be connected to the companies or pension funds or insurances culture. It can be a leadership thing. It can be a pressure from outside, but it can also be a specific experience that the investor has built, or the investment team of the investor has built. And I think today we are going to focus on an environmental goal, but it can also be social goals. And then the goals as such can be defined on various levels, either on a portfolio-wide level, so top-down, or on a carved-out, just a portion of the overall portfolio. Goals, of course, should be qualified or quantifiable. The rule is more is better than, less is better than much, just to clarify, or just to be, just to make the entire implementation process simpler. Also, the time horizon is important. I think, again, when looking at, for example, the Paris Agreements or the climate aspect, somehow the time horizon is given, but of course it can vary a lot depending on what kind of goals one sets. And then very important is, okay, once the goals are there, how do we actually implement now, or what consequences does it have on the implementation and the investment process as such? And that is very important, and is actually not yet, in most cases, very well realized. But the fact is that one has to go thoroughly through every step in the investment process, or depending whether one has internal asset management, external, define the criteria of how to select an investment manager that can work towards these goals, or also give the internal asset managers or portfolio managers the right guidelines so that they can work towards the goals. And that should all be somehow codified in official documents. Of course, if it's an external asset manager, it should be the agreement or can be a fund prospectus. Reporting, of course, is important. As I said, measurement and management of impact. Unfortunately, there is not yet one standard available, but there are, in the meantime, various tools that make it, or that are helpful in finding the right reporting standards. But it's also very important to take the time to actually decide with the asset manager of what kind of KPIs should be collected and really make sense to get this additional information. Last but not least, talking to each other is super important. I suppose this will be touched on today. Everyone is still in a learning process. Nothing is really set yet. So therefore, this communication helps clarifying and actually aligning the different actions of different participants. So with this, actually, I'd like to hand over to my the next speaker, who is Vincent from Ethos Foundation.
Hello, everyone. I hope you hear me. So sorry, first of all, not being present here. I'm not very far, but I wanted to keep my COVID for myself. So it's still here. It's coming back. So yeah, I feel good, but it was better to be online. Thank you, Miriam, for the wonderful introduction. I think it's a very important distinction you made right now regarding ESG impact, this double materiality aspect. So at Ethos, we are more focusing and specializing actually on listed equities, but I would like to try to give some overview of potentially how we can also integrate those impact within active ownership strategy, and how can this be also applied in private market, private financing, private debt, or private equity, as it is. So, and I also would like to give some background information on the Swiss pension fund. So basically, Ethos was created 25 years ago, really for proposing sustainable investment for pension fund, mostly in listed equity, listed debt. Was already a challenge, I would say, to convince pension fund to have such an approach, reducing investment universe, trying to integrate those ESG factors. 25 years ago, it was still not absolutely not mainstream. But we rapidly took the impression that was very important to integrate those ESG factors. But if you want to have impact on your investment strategy, especially as in listed equity on the listed world, you are more on the secondary market. So it's more difficult as you have in the private equity world to have a direct impact on the companies or on the real economy with the financing policy on the financing aspect. So being on the secondary market, the only way for us to be able to change companies and make them more aware of their responsibility, I would say, and trying to change them from inside was using active ownership strategies. And that's, I think, something Swiss pension funds liked a lot, because it was also a way to still integrate those sustainability strategy without necessarily changing too much the portfolio. Yes, I think it's on the listed equity world, it's, in my view, the best way if you really want to have an impact on the real economy. Of course, if you want to protect your portfolio, then you also need to certainly restrict from certain investment, exclude certain companies. And that would be in an ideal world that this capital that you might restrict from those bad companies, let's say, be reallocated towards more sustainable companies or more sustainable investment strategies, such as impact investing. In reality, what I see from the Swiss market, it's still on the asset owner and pension fund, it's still a very diverse market. We have more than 4,400 pension funds. Most of them are quite small, don't have really internal team, tend to delegate and tend to rely a lot on consultants. And so if you want to convince more, I guess, pension fund to go in impact investment strategies, certainly consultants play a key role, at least among the smaller pension fund. We're still very far from the consolidation of pension fund that happened typically in the Dutch market, where I think those impact investment strategy have more place. We still see this consolidation. We have more and more bigger players who have capacity and tend to have internal team to be able to have such investment strategies, which still requires a lot of follow-up, I would say, from the investors. So yes, consolidation is happening. Legislation in Switzerland also moved at the beginning of the year, allowing a higher threshold of investment in private equity. There is a new threshold of 5% of the total asset allocation of a pension fund, which can go in Swiss private equity or Swiss private debt. So I think it's a welcome amendment. I'm not sure now on the statistics are not yet available what impact it concretely had on the asset allocation of pension fund, or if it grew a little bit more those kind of impact investment strategy in the private equity or private debt world. So I'm looking forward to discuss with a colleague on the panel of the challenges and how we can push forward pension fund towards those investment strategy. I think first criteria is clearly liquidity, which has to be something present and of course, risk appetite of pension fund and also diversification, which remains the key aspect for pension fund. I stop here and I'm looking forward for the discussion.
Thank you, Vincent, for this. We'll hear from you in the panel. And with this, I would like to hand over to Grégoire from CPG.
Thank you. Thank you for having me here today. I think the first, the GIN definition, I think, is key because we need to have the same definitions, the same norms, the same processes to do the right thing. I think we have no time to waste, and for this reason, we must all go into the same direction at the same time, at the same magnitude. I had several discussions during the Building Bridges event, and then the conclusion was we all have to collaborate. Separate initiatives are not going to lead us far. And as you may know, I'm the special advisor of the board of the IIGCC, which stands for the Institutional Investors Group on Climate Change. That's the largest activist group in Europe, and we engage with policymakers, corporates, and fund managers. And then we had a discussion with the head of climate in Europe, and we said, we're doing all this to avoid the car to hit the wall. And he said, no, we have hit the wall. We have to do all these things, investments, and because we want to, the car is spinning and we want to avoid damages. So this is the degree of emergency we're in today. So I'd like to repeat the 4 asks of the European Union. The first one is to decarbonize and manage the temperature of your investments. The second is engagement. The third is invest in impact investing. And thirdly, reporting and transparency. Amongst the 4 pillars, 2 have a concrete impact on the environment. The first one is impact investing and obviously engagement. So at CPG, we have decided to tackle impact investments because of the degree of emergency. One of the outcomes of the COP26 was to create public-private partnerships, to syndicate ourselves. If we look, and probably Vincent is more aware of the situation of pension funds in Switzerland, but the allocation, and according to the GIN definition of impact investing, allocation into impact investing strategies in asset allocations is very small or inexistent. And our biggest constraint is we want to dip a toe, but we don't know how to do it. And we thought to collaborate together, syndicate institutional investors together, and collaborate with the government was the right path. So again, it all boils down to the definition risk. We don't want to invest. We have a liquidity risk. We don't want to invest in a solution that ends up not being an impact investing solution. You know, hybrid car engines were a good solution, but we now end up. We found out that actually it's polluting the atmosphere. However, a lot of households have bought those cars. So we don't want to have the same risk with our investments, and collaborating with the government in terms of taxonomy or in terms of impact or exit strategy, we want that to be aligned, and we want to do the right steps. So we have started to syndicate investors, and we have looked for a manager. I think Vincent tackled a very important point. We need diversification. So it is a new strategy, not really new because it's been there for the last 10 years. And we see a lot of tiny projects, but the industry is so fragmented. It's so difficult to create a diversified portfolio and coherent. We need to be diversified in terms of geographies, in terms of sectors, technologies, and so on. And then we thought, what is the right strategy to adopt? So we have to decarbonize our economy. This is a must, but it's not sufficient. We need to tackle the risk that we're facing. We need to invest in the fourth industrial revolution. What is an industrial revolution? So we need two things. One is a new technology, and second, we need a new source of energy. And I would add a third pillar is storage of energy. So we believe that we need to decarbonize our economies, but at the same time, we need to invest in the fourth industrial revolution. And that is going to really have a concrete impact on the environment. So the group has decided to focus on climate tech. Today, we have enough sufficient background to reassure investors that we can tackle all those different impact investing objectives. We can have a decent return, actually an attractive return. We can have, and at the same time, we can have a concrete impact on the environment. So we have looked for the proper manager, and the EIF, the European Investment Fund, which is the financial arm of the European Union, was the obvious choice. So we've had several working sessions. And then I want to thank, well, the GIN first, because you participated to those discussions. I think it should be framed within the GIN. And then I want to thank the European Investment Fund, because they've been extremely generous with their time. We had over hours of discussions, and then we have now come with a very interesting solution for investors in Switzerland. And then we are very proud to say that that would be one of the first public-private partnership initiatives.
Thank you, Grégoire. That is a very promising start, and I hope it will grow very fast and very big. With this, I'd like to hand over to Joaquin from EIF.
Thank you. All right, so briefly, my name is Joaquin Ruiz. I work in the EIF since 2008. I've always been on the investment side, very much focused on primary fund investments for the, say, the first 10 years of my career, and then moved into the co-investment world. And for the last 5-6 years, I'm responsible for the secondaries activities. And we're both buyers and sellers. And I'm glad to say that even in the secondary space, which is relatively recent when we look at private assets and very small in terms of, I would say, volumes compared to the primary market, it is actually a very innovative strategy, which is also tapping into some sort of impact investing and having its contribution. Now, what I will do is I will briefly introduce EIF to deep dive into who we are, what we do, how we are set up, what is our, I would say, objective strategy, how we operate in the market, to then move into what have we done in impact investing, and perhaps bring one case study, one successful case study that we set up approximately 10 years ago that has been deployed and has already had quite some impact. All right. So the EIF is in itself is a public-private partnership. Actually, we were set up approximately 25 years ago. Some sort of a spin-off from the European Investment Bank. For those that don't know, the EIB is the EU Member States Development Bank. So it's owned by the 27 member states. And we are the SME arm of the EIB. So it means that we operate in the market with an angle to develop the market, the lower end of the market. We focus on small, medium-sized entities, small caps and mid caps. And we do this essentially with two products. We are active on the debt side, and we are active on the equity side, the private equity side. So I'll come to that in a moment. As you can see, in our partnership, we have, on the one hand, the EIB, we have also the European Commission, and interestingly, we have also a small portion of private investors, like financial institutions, banks, etc. And even though we are mainly public, the private component is actually giving the EIF a commercial spin. So anything that we do on the market with the idea to develop the market, we also do it as well with the commercial hat. We are not investing in a fund if we don't think that we are going to make a return. If, based on our grading methodology, we think this fund will lose money, then that's not for us. It has to have also this return component. We have a large capital base. We are a AAA rated institution. Last but not least, in the equity market, we have done quite a lot of investments. So far, we have a portfolio of 1,300 fund interests, so it can give you an idea of the dimension of the institution. As you can see, more than 35 billion committed. So it's quite a big machine. All right, so I was saying that we are active in the market in two ways, through debt products. I think Vincent alluded to a similar product that we deploy in the EIF, which is guarantees. So we provide guarantees to financial institutions, to banks, so that they would lend more to small, medium-sized companies. And let's say that if things don't go well, we take part of the loss, no? So it's a way to incentivize the loan to the smaller end of the market. That represents approximately 50% of the business of the EIF, and the other 50% is equity. And to put it simple, we operate as a fund of funds. And as a fund of funds, we have two main strategies. We are active on the venture space, from anything that is tech transfer to late-stage venture. And we are active on what we call the mid-market or lower mid-market. So we would invest in funds, in strategies that invest in companies that are more mature, more a little bit sector agnostic, and we would also invest in credit funds, from venture debt to preferred strategies to mezzanine to unitranche, senior lending, direct lending, etc. Important to say, we think, I don't know if we are, but we think we are one of the largest investment teams in Europe. We have approximately 80 investment professionals that are exclusively focused on investing in the venture space and the mid-market space. All right, how do we operate in the market? So basically, I was saying before that we don't do an investment if we don't think that we are going to make a return out of it. But obviously, depending on the type of strategy that we intend to deploy, the resources, the market, we will be more policy, so more development focus, or more return focus. So if you see on the left, we are more market developer. So for that, historically, we've been using resources from the European Commission, which is very interested in filling the gap where the private sector is not having a role or not yet a sufficient role. We would typically back first-timers, so first-time teams, first-time funds, people that have an interesting experience, but they've never really been investing in the past in an institutional setup. Once these funds become, to some extent, experienced, so they may have not done exits yet with the funds, but they're raising the second fund, we call them emerging managers. It could also be a fund that is raised by a team that was previously in another fund setup, but they decided to spin out. I mean, this is something that happens quite often. So we would be more some sort of a market catalyst. And for those funds that are already, let's say, pretty successful, they're going through Fund 3, Fund 4, etc. We still consider that there is a merit in supporting them because they are very experienced, very professionalized. They add a lot of value in underlying portfolios. Then we call ourselves, we provide a market access. Of course, the resources that we would use in the market access phase are not the same ones that we would use for the market developer phase. The type of risk is different. You would not expect, even though there are very nice surprises with emerging and first-timers, but you would not expect to have the same type of risk in a team that is in Fund 3, Fund 4, than in a team that is raising its first initiative. So that is how we basically operate in the market for the last 25 years. Now, what have we done on the impact side? So the impact side, I wouldn't say something that is relatively recent, but clearly if we compare with when we started investing in the market 25 years ago, it's it is relatively recent. I mean, it's about 10 years that we have set up a more dedicated platform with a dedicated team, dedicated resources, people with the right skills and experience in order to tap into this ecosystem. So far, we have approximately 1.3 billion of available resources, which across the different strategies, equity, debt, we have committed approximately 1 billion. And in equity, so we focus on the venture space, where we've been quite active. This represents north of 400 million and 28 fund manager relationships that we have supported. If we look at how many companies we've tapped into, and that is a number that is growing, it's more than 300 as we speak. So 300 companies which would fit in this impact strategy. Now, we've been, I'd like to say, quite instrument in the design of an impact strategy. As a matter of fact, the main responsible professional of the venture team is someone called Uli Grabenwarter, that maybe some of you might have heard of. More or less 10 years ago, a bit more than 10 years ago, he decided to take a sabbatical leave in order to go to one well-known business school, IES in Barcelona, and he basically did research with other professionals and experts on impact, and contributed to developing a strategy, a framework to do impact investment. So even though we don't claim to be the ones that have created the impact methodology, far from that, but we've been instrument in that role. And this is something I'm glad to hear what was discussed in just before my intervention about how this is measured, how this is monitored, implemented on a daily basis. So we have, if you want, simplifying a 3-steps process where once we have selected a GP, which we consider has the right skills, the investment experience in order to develop and implement an impact strategy, we would set up specific KPIs, which we would define for every single company. They have to be measurable, of course, and we would track the evolution of these KPIs over time. Of course, not always we would achieve 100% of what we expect, but we would hope that the GP is effectively implementing these KPIs in each and every investment. The outcome of that is very simple. If they have achieved what has been agreed and what has been legally enforced in the legal documents of the fund as an objective, they have to do it. If they don't do it, then this will have consequences. They would basically not be able to get the so-called carried interest. So of course, things are not black or white, so we would define certain percentages of completion per company that is aggregated at fund level, and if the outcome is, as you can see here, above a score of 0.8, they would obtain the full carry allocation. If they are between 0.6 and 0.8, it would be between 50 and 80%, but like if they have not delivered, if they have not done what they are expected to do, then they would not get the carry. So what a nice way to enforce alignment across the industry, across the value chain in this asset class. The last thing that I wanted to highlight is an example. So the SIA is basically a program that was raised in 2013, approximately 450 million in size, this time on the social impact. So it's called the Social Impact Accelerator. As you can see, with a number of institutions that contributed to this program, and we backed 18 funds. So the methodology that I just explained, I mean, we have implemented this methodology in all these investments, and today we are seeing already the first exits. And again, you can see that the capillarity is quite interesting, with 250 plus companies supported up until today. And with that, I will stop here, and then we move to the other discussion. Thank you. Oops, sorry.
Okay. So with this, we actually move to the panel session, and yes, we'll take questions from the audience in a minute. Maybe we're wondering. I mean, we have tried to present in very brief, let's say, an impact investing solution for an institutional investor. And maybe it would be interesting. Do we have other institutional investors in the audience or intermediaries that work with such investors? Maybe if you want to raise your hand. A few. Okay. So you're very familiar with the challenges and needs. And look, just to summarize, maybe what this solution is about, as it has been presented by different speakers, and maybe just to recap. So your pension fund basically took the decision that you wanted to become active or an active provider in solving or contributing to the to solving the climate problem, and you have decided to go this route of financing tech companies, which should help mitigate the risk, right, or mitigate the problem. So that's actually, so in that sense, you have set an impact goal and an impact strategy. The solution then is going to be a fund-of-fund approach, right? That will be managed by EIF. And the fund approach is maybe not the most popular within the institutional world, but it clearly has in this context big advantages, because it helps on the one hand to size, basically, achieve a reasonable size of assets in a relatively easy way. Contributes to diversification, that has been mentioned several times, also in a very smooth way, so to say. I guess it should also somewhat help to learn everyone or contribute to the learning process, which we are all still in. And you have chosen this partnership. I think it was also mentioned several times, the need for partnership to move in impact investing. So the collaboration with EIF, who brings a lot of knowledge, experience, also access to investments, and also I think what has not maybe been fully presented, but there is also supposed to be a de-risking mechanism in place. Because again, I think it was mentioned that the strategy is to finance VC, so that involves essentially a level of risk that not many pension funds are willing to take, but there are, in collaboration with governmental entities, options of or solutions to de-risk. So maybe just to set or to kind of summarize. I'd like to start with a question to you, Grégoire, because in connection to my introduction of pension funds defining an impact strategy, I was wondering, like, how did you get to this point where you decided, as a pension fund, I mean, where you decided to carve out a portion of your asset allocation and invest in impact, or are going to do so, and why, and maybe just on the process of how you got there, so that maybe some of the public can learn, of the audience can learn, like how to go about it. This doesn't come overnight, right? so yeah, what are your takeaways?
Well, your question is what would be the proper allocation to such strategies, or
and how did you come about this? What was the internal process to get to this decision to integrate it into asset allocation?
Well, we were very much inclined to be an active player in Switzerland. I think one of our first sustainable mandate was set up in in the beginning of the 90s. So pension fund of the state of Geneva has always been a pioneer in many different ways. Now, we are convinced, and the good news is we can tackle all those objectives at the same time. So we can have an impact and as well deliver a decent performance for the beneficiaries. And that was not so obvious a couple of years ago. Why we are so optimistic about this strategy is we want to have a concrete impact, and the way the right path for us is to take a bit more risk and invest in the VC and in climate tech. That was not CPG's decision, but it was the group who wanted to have higher return than what was initially thought after. Unfortunately, the social impact was not a priority, but maybe it will come. We then had the alternative to either invest in emerging markets or developed markets. The needs are and the priorities are definitely in emerging markets. But as we are dipping a toe in the water, we want to feel safe. And Europe is probably the most advanced region in the world when it comes to sustainability and more importantly, climate. So we thought the regulation, the governments, and it's so important. Taxonomy is so important for us. We don't want to make a mistake and invest and being, as Vincent said, we're stuck with this investment, which end up not being an impact investing solution. And then again, I insist on definitions. Coca-Cola claimed that they are an impact company because they created 20,000 jobs. So we have to make sure that we don't fall into those traps. So that's the reason why we naturally came in to the EIF to ask them to collaborate with us. So that was the only solution.
Okay, very. Maybe in addition here, a question to Vincent. You are, I'm not sure if this works actually, but you can hear me. Okay. You are working a lot with pension funds, or well, generally, of course, institutional investors, especially for engagement, which I mean is somewhere can be on the way from the more risk perspective to a more proactive impact perspective or approach. Do you see? And it was, I think it was said several times today that in Switzerland, let's say within the institutional investors community, their impact investing is still very small. But you work also beyond Switzerland. Do you see a trend that more institutional investors want to become maybe through the engagement path, basically more active and proactive in a way?
Yeah, I think the trend will be here, and I really welcome the initiative of CPEG because I think they are, as Grégoire said, always been a front runner. They created actually Ethos back in 1997. It was one of the two pension funds who were at the beginning of Ethos. So, but yeah, I think we need always in the pension fund world, they have two jobs. They are insurer and asset managers. So they are quite risk averse. They have a mandate to pay the insurance at the end for the retirement. So I think this is a very important mission. And as they are sometimes risk averse, they need early mover, courageous pension fund to show the way. So I hope it will be the same experience with this fund of fund and initiative from CPEG as it was for Ethos. We started with 2 pension funds. It was really difficult at the beginning to convince pension fund to delegate their voting rights, to start voting at general meeting, to start engaging. And they rapidly realized they could have an impact on the listed world by being an active owner. So nowadays, Ethos has more than 240 members. So we had those 2 courageous pension funds back 25 years ago. And hopefully we are on the same traveling journey as we were with active ownership. Now, no shareholder investor says it doesn't make engagement. So there is certainly a little bit of greenwashing there. But anyway, I think they still have an impact. So I think the trend will go, and thanks to such initiative and the work of EIF and all those fund of fund structure which address some of the diversification, liquidity, and I think that's convincing and should really convince. I would still say it's more fitting large pension fund. The smaller one will anyway delegate the asset management to a bank or two, but for large pension fund, definitely there is hopefully an evolution in that direction, because again, capital need to be reallocated to solutions. This is a Paris Agreement. So in the listed world, what we say usually to pension fund is that as a shareholder of a company, we have to ask the board to redirect capital flow. So review the capex, typically in the oil and gas industry. Now they have to accelerate towards renewable energy. But the companies who don't want to do it, at one point we need to exit, and certainly we need to reallocate towards alternative other investment strategies, which will redirect capital flows to the challenge we have. Because I think it's everybody agrees on the emergency situation in which we are, which really requires those technology to develop rapidly. But again, if I come back, everything is connected, because if I come back to active ownership strategy, what we ask to large multinational company is to set ambitious climate strategy nowadays, science-based target. That means, and especially on indirect emission, on the supply chain of those large group, and those large group will come back to smaller companies, suppliers, in order to have those suppliers comply with their requirement. So that means this top-bottom approach will definitely have also an impact on the small and mid cap and the real economy. So it's different way of pressure, which hopefully will accelerate the change. So again, welcome the initiative. We will try to work also with CPOG to convince other pension funds to move into that direction, because I think this is everything we can do to accelerate the transition has to be done.
Thank you. Maybe Joaquin, a question that goes also a bit in that direction. You are obviously working on a European level. And have, I guess, other examples you could share. What's your observation of mobilizing institutional capital to basically for impact investing, and what are your learnings from there that are maybe different from the current solution we presented?
Does it work?
I think they put it on when you speak.
Hello? Yeah? Okay, good. Well, I'll bring one data point. More than what type of investors are supporting impact funds, let's say, from our perspective, how has the market evolved? So I said that this activity is relatively recent in the EIF, 10 years. 10 years, we were receiving or sourcing more or less 5 to 6 new proposals per annum. And they were very, very small in size, no? So there were just a few courageous investment professionals trying to raise a fund on the impact side. That has increased quite a lot, to the point that, I mean, today, or at least the latest data that I have in mind, end of 2020 or 2021, we're seeing more or less 35 investment proposals every year, of which the EIF is investing in more or less 20% of them. And that has been, I mean, I have the chart in front of me. It's been really exponential. And what has also increased, I don't have the average size now, but I can confirm it, is the average size of the initiatives, and it has increased probably 5 times or 6 times. So no doubt that there is interest, but no doubt as well that the contribution from players like IFIs or DFIs, like EIF, has been and is today critical to make sure that these funds, they reach a first close, a viable first close, and they start operating. Without that, I mean, we're not at a stage where the market, without the intervention of a player like EIF or other regional or national similar players, could be KfW in Germany, could be DG, similar players like this, Bpifrance in France, this would fly.
Thank you. Yeah, we'd like to take some questions from the audience.
Thanks very much for the very interesting discussion. Maybe to Joaquin, one question. You mentioned how it has accelerated the number of proposals you're seeing on impact. Could you give us your impression? Are these, let's say, different, genuinely different proposals representing kind of a new market, so to speak? Or is it from the subset of proposals that from the proposals that we will be getting anyway, those proposals with the most impact because of the underlying nature of project or so on, knowing now that there is an impact lens out there, really identify themselves as such? And just related to that, you mentioned that you're looking for market return in that 50% of your portfolio. For a return. Is that market return, or do you also have a concessionary outlook there? And if I may, very, very briefly, because I want to ask you this as well, it's so interesting what you've said regarding the carried interest and the arrangement with GPs. I guess there are also other LPs. Do you put a lot of effort in identifying those other LPs that are really like-minded? Otherwise, how does this work? You need to have an agreement there. Thank you so much.
I'll try. Hopefully, I don't forget. I mean, on the first question, I mean, there's no doubt that today a lot of established fund managers. So, in my explanations, those that are raising Fund 3, Fund 4, Fund 5, they are adapting. They see that. I mean, today, if you don't consider climate. I mean, I'm not going to say that you're not going to raise a fund, but it has to be part of your strategy in some manner. So we are seeing some of these players that seriously, not all of them. There is a bit of greenwashing as well, but some of them are coming to market with dedicated strategies, funds, dedicated team, with a proposed impact strategy, which is not necessarily the flagship strategy, but they have seen the opportunity and they are tapping into this segment of the market. So that's one thing that we see. The other thing that we see is those that I mentioned, that 10 years ago there were 6 proposals and today there are 35 proposals. I mean, these are genuinely new teams or experienced teams that have left a fund manager, a venture fund manager or a mid-market fund manager, and that have decided to set up a firm and a fund with a fully focused impact strategy. We see both things. And we think it's positive because on the one hand, we see new teams from scratch and we are seeing the old boys, in a way, adapting to what the market is demanding and where we have to invest. Very experienced investors with large teams with a proper infrastructure, teams that are focused on monitoring, on implementing actions, etc. Not only investors, but operational people also going into that direction. You had a question on the return. So maybe I wasn't clear, but there is not a single investment in the EIF. I'll put it this way. Our grading methodology, which has been developed for the last 20 years, actually there is even a couple of books in the market, well known. It's a methodology that, put simply, in a primary fund investment would grade the expected return performance of a fund as an expected first quartile, second quartile, third quartile, fourth quartile. I can say that 98 or 99% of the investments that are made by the EIF, they have to be at least expected third quartile. So it would be below the median, but it would be, in principle, it depends on the vintages, of course, but but in principle, we would be expecting to make money out of it. Now, in a third quartile performer, again, depending on the vintage, you would not expect to make 2 times or 3 times net the money. No, you might recover the money, maybe make a little bit of return. No, on the second quartile and first quartile, you would expect to make, I don't know, 1.6, 1.7 above, and then much more on the first quartile performance. So there is not, I don't want to say there is not a single, but I can say safely that 99, 98% of the fund investments made by the EIF, we don't do them if we think that we're going to lose the money, just to start. Now, the thing is that, again, depending on the resources that we use, the market, the country in which we invest, the sector-focused strategy of the fund, today we are moving into thematics, sector-focused funds, etc., then we will adapt the, if you want, the expectations of return that we would have for that investment in particular. And the last question was on carried interest, I think.
Yes, if you need to have an agreement with all the LPs and how difficult or easy that is to put together those type of mandates that you mentioned.
Well, yes. I mean, the thing is, if there is only an agreement with the EIF, in practice, it would be negotiated through the side letter. But the side letter, as we know, is typically, there are some exclusions, MFNable. So you, as another investor, as an LP in the fund, you can say, I also want to benefit from these rights. Now, at the end of the day, the problem with the side letter is that it's a bilateral agreement. And it would be more difficult, if you want, to enforce that agreement if it's only on the side letter. So the objective here is to put it in the main legal documents of the fund, in the LPA. And if they don't deliver, I come back to what I explained before. Bad luck, there's not going to be the success fee. If they deliver reasonably well, there will be some carry. And if they really do what we were expecting them to do, then they will get full carry, you know?
Are there more questions from the audience?
Hi. You will get from my question that I'm a data scientist, but data is the elephant in the room. I didn't go to all rooms, but it was always a statement like that. So my question is, actually, I was a fund of fund managers a long time ago, and I know that adding this layer is actually increasing complexity. And so I wonder how you do about gathering all this reporting data into a proper framework to actually see where you are.
I guess this question goes to EIF and not the Well, from the GIN, I can just say, well, obviously I'm speaking for the market, but again, I just want to point to one of the findings from the group that I mentioned earlier. The thing, I mean, you're totally right. The data and measurement and everything is still is a big thing and not entirely solved. However, less is better. Less but good quality KPIs, and of course it depends totally on the strategy of what is possible to collect from the investees that help measuring really the outcome. But I think to be concrete, I'd like to hand over to
Thank
my
you. Just for 30 seconds. One of the constraints that we wanted to deal with is reporting and transparency. And data is, of course, a big constraint, both in terms of frequency, quality, granularity, and so on. And we thought that, again, collaborating with EIF would solve some of those issues, because the data they're using is more reliable than, relying on newly set up managers. So that was another reason why we wanted to collaborate with the EIF.
Well, now I will refer to the side letters. Of course, I mean, there are certain requests that we will demand through the side letter. I mean, a side letter just for the fund. When I joined the EIF in 2008, I think it was less than 10 pages. Today it's like 60 or 70 pages. So sometimes it's even longer than the limited partnership agreement. which, as you can imagine, ends up in sometimes difficult discussions with the fund managers, especially the small ones, because it's an element of complexity and bureaucracy that for them, no, it has a cost that is not easy to deal with. No, but I mean we ask for information, specific information on the underlying companies, on sectors, etc. And we track that. We put it in the system. We're using eFront, and basically this information is there. We can extract it. We can play with it. We can do a lot of things with it.
Maybe if I may, in terms of engagement, we also had this experience of fund in private equity that we launched in 2011. So it's over now. But it's clear the weight GP has in the investee company is usually quite high. So if their own limited partner LP are requiring such information inside letters, they can go back to the investee company with higher pressure because they often have a board seat. So if those GP are convinced about getting the right data, of course it's complex for a small company, but if you focus on specific KPI, those companies has to be prepared. And if it's their value proposition, sustainability, usually it's in their DNA to be able to demonstrate their impact. So it might be sometimes easier to get those data, maybe on a less standardized way, but with the weight of in the private equity field, as we have in the listed equity world, where companies actually their shareholding base is so diverse, they face requests from different investors, and I know from different chair of board that they are quite underwater with different kind of requests. So they on the listed equity world, it's quite difficult there. Also, there is standards. But if there is more focus on the shareholder base of a private company, I guess there is where to be more specific and collect the right data. And as Miriam said, the less is sometimes the better if it's a material and relevant data. So I don't know if it's an experience you have, but I guess with the weight in the private equity world, potentially we can get better data.
Thank you. Good morning. I was just wondering, with the evolution of SFDR coming up, where you will have to show negative impact as well, are you already prepared to tackle that point in the future?
I mean, I hope so, no? I mean, so far hasn't been the case, but yeah. Yeah, I guess, yeah.
Thank you. I work for an impact asset manager, and the question what I have probably goes to Gregor and maybe partially also to Vincent. What we notice is that DFIs play a great role, and they're very helpful. We run, for example, a mandate for British International Investment. And what I would like to know is, I'm just sometimes wondering a bit why are pension funds in general, and in particular, I have to say in Switzerland, so hesitant to engage in impact? Is it mostly really a question of risk, like being it reputational risk, being it like risk of losing assets? Because obviously you need to be conscious of your responsibility. Or is it just lack of knowledge? Is it just a hassle? You know, I would just like to learn a little bit more about that, and just to maybe share also from our side that we think that Switzerland, at least on the asset owner side, is lacking. And the Anglo-Saxon world, I have to say, is much more open and advanced, in particular when it comes to emerging market investments. So yeah, if you could just share maybe a little bit like what's stopping, in general, pension funds to do more. Thank you.
Well, I think pension funds are very conservative, and they would not do any initiative unless they have the pressure to do it. I personally believe, and I'm based on the discussions that we have with policymakers in Europe through the IIGCC, regulation is coming into play, and no matter if you like it, you believe in it, you have values, you will have to invest in impact investing. So this is going to change, not because we want to start a new strategy, it's because we will be forced to it. We discussed with the Minister of the Environment in France, and he was, we talked about the yellow vests, and he said we cannot put more pressure on consumers because that's the result. So we will have to put pressure on asset owners. So this pressure is going to grow over time, and that's why we have decided to be an early mover, because we'll have to tackle that, so we prefer to do it the way we think is right. Coming back to your question, there are two things. One is private equity investments in Switzerland, and there's private equity investors in Switzerland. So I think private equity investors, we had for many years, many decades, investments in private equity, but outside of Switzerland. So I think I can claim that our peers are in the same situation. And we have a few asset owners here, and they are pioneers in private equity. Now, coming back to the private equity market in Switzerland, I don't want to insult anyone, but I think we don't have the culture yet. The culture of failure, the culture, the Anglo-Saxon market has a very different mindset when it comes to private equity. I hope this is going to change, but we're not there yet. So I believe that we will have to fund impact investing solutions in Switzerland, and I hope they will flourish at some point. But I for the time being, I don't think it's there yet.
I think I echo this, but I think also the culture, the tradition of financing business in Switzerland was really debt-oriented with secrecy. If you look at the history, financial market in Switzerland and also pension fund investing in equities is not that, even in listed equity, the CPEG founded the ethos to have this asset class, otherwise it was really bonds or real estate. So we're still quite young in this new way of financing via equity generally. So even listed equity, it has grown. Nowadays, listed equity is about 1/3 of asset allocation, but look, 15 years ago was certainly less. So I think because it has to do with this tradition of financing. So we're also pushing a lot of our large bank to have some policy, incentivize also on corporate loans. Because this is key, and that can be done with engagement. If we are shareholders, investors, Credit Suisse or UBS, we can also push them towards financing via their credits to companies and have some green credits. So this is also moving in Switzerland. So because I think it's part of the culture and the traditional way of financing business. It's either family owned or really oriented via bank financing. But it's changing again, and the trend we've seen in listed equity, I'm convinced, as Grégoire, that it will move. Not necessarily with legislation, because I'm less optimistic on this side. EU certainly, but Switzerland plays a lot of self-regulation. It's not with Swiss climate scores that we will trigger impact investing. I mean, this is okay, that's per personal view, huh? But it seems the interest of doing it will grow. We had the same with voting rights. Pension funds were, at the end of the day, obliged to vote. This is true, through an initiative, the Minder initiative. Before that, we still had a couple of them doing it because they saw the interest. So let's see. But yeah, I hope we can really see some development there. Again, I think this has to do with traditional culture of financing in Switzerland.
Maybe if I can add here, I think there is now there is more awareness for, let's say, going or within the pension funds in Switzerland of awareness of the climate issue, right? And I think that's a bit the anchor where they start to think about, we could go beyond ESG. Yeah. This doesn't yet involve other impact topics, but I think it's a good start. But another observation that we can make globally, basically, is that the large or those institutional investors that are much further in terms of impact investing are mostly insurance companies, and the type of, I don't know actually in English or French, but the Sammelstiftungen, so the pension funds that are like in a collective scheme. And it's I think the reasons for, well, first the insurance companies, it's really because of the nature of their business. They look much further ahead, and they act much earlier. And I think the rest will follow eventually, as we can see. And with the collective pension funds, it's obviously a matter of also distinguishing themselves. It's a little bit of a marketing, or well, it's basically a part of the DNA of this, and why certain customers should go there or not. But these companies are growing quite well, not only in Switzerland but also abroad, because actually they give to provide to the insured people a lot more identification. So I mean, I know your position, and it's very hard, but it will change eventually. I'm convinced.
I have not mentioned peers that think they're already exposed with the theme or the strategy.
Yeah.
They say we already have an allocation, and when you look at it, it has nothing to do with impact investing. So it all comes back to the definition, and I think that's why it's important to have a framework that is shared globally. So we all move the same way, same magnitude, into the same direction.
Yeah, you're totally right.
And also, private initiatives will not help. We need to combine our efforts. So we're very pleased to have Ethos, we have the GIN, etc. We need to collaborate all together, and that includes the governments.
Are there more questions?
Yeah, hello, Yves Leis. We develop two different fund with for renewable energy. One is Africa and Central Europe, the other one. But we are surprised that, in fact, in Europe, or at least in Switzerland, it's very difficult to talk about this, even if it's good. And we have to go to Scandinavia, where, in fact, investment fund, pension funds are much more open for this. So I think maybe there is something to see how they structure, why they are incentivized, in fact, to look at renewable energy.
Yes, I think this underlines basically the observation you have made before. Maybe, I mean, we can ask in the round, or maybe especially Grégoire and Vincent, you know, do we need some regulation that kind of encourages the pension funds to become more proactive? Maybe not only for the climate issue, maybe beyond?
When I say that we'll get at some point pressure from regulation, my colleagues tell me don't say that, because the regulation will never be able to force an asset owner to invest in a specific investment solution. They cannot. I said, but yes, they can. And I said, take the example of cars. We started to measure carbon emissions of cars, and it was just all by curiosity. And then we did rankings. And then the government drew a line and said, everything under this level of carbon emissions is going to be taxed. And why? Now they are putting pressure on asset owners to measure our carbon emissions. But that's not for curiosity. At some point, they're going to rank, and they're going to tax investments that are too intensive. So I think that is the type of pressure that we're going to get. I'm also extremely interested in carbon residual emissions, because we'll all have to face this issue. We can decarbonize our investment up to a certain point. We can lose weight up to a certain point, but then we need to deal with those residual carbon emissions. And impact investment solution will help to compensate those residual emissions. So I'm extremely optimistic and bullish about negative carbon emissions solutions. We're discussing at the IIGCC on what would be the right strategy for corporates or for investors to compensate those residual emissions. And I think one of the outcome I can share with you is, first you have to have you cannot just compensate. You need to have a transition strategy in place, and you have to, I think you have to be net zero, commit to net zero in 2050. Then you can deal with that. But that's an incredible opportunity in terms of investment, is to deal with those residual emissions.
Maybe if I may take devil advocate on a little bit here, but it's true. We still have, as I said, 1,400 pension funds. The board of trustee of a pension fund is the ultimate responsible. These persons are often not professional of the finance world. They dedicate some times personally without being paid, and with having more responsibilities than a board member of a listed company, and are almost not paid. So these people dedicate some time for it, and are not always professional of the field at the beginning. So education is key on those pension funds. But yeah, I still can see that they are still taking some personal risk, and that's why they tend to be quite on the risk averse side, and trusting a lot again the bankers or their consultant and those people play also a key role. And so I think consultants play a key role in Switzerland, and we have also to influence them ongoing on that direction. And I guess Grégoire has a big pension fund. Those consultants listen more to large pension funds, and you can influence them as well. Because once they can also spread the word among their different clients, smaller pension fund, then we can have a critical mass. So that's just to say that legislation in Switzerland give a lot of power to this board of trustee, and those board of trustee are militant. So that's also something we have to take into consideration in more alternative investment strategy. And yeah, but still, I think with the consolidation we are seeing, 10 years ago, we had more than 3,000 pension funds, now 1,400. I guess in 5 years, you will have less than 100. So weighting will go higher on those Sammelstiftung, as Miriam said, and those one will have internal team, and certainly the trend we have in the Dutch market, again, with more professional team, people knowledgeable on different investment strategy, having professional of the different asset category, will also, there will be an evolution, hopefully.
Okay, I think we need to close shortly, but if you allow, we just go through a very last question. I hope we were able with this group of speakers to present a positive and strong solution to tackle the climate issue and hopefully also other impact topics going forward. And we have heard in this context the importance of partnerships. So to all of the speakers, I'd like to ask basically the question, for the partnerships to work even better, what's your wish to your partners or future partners? It can be, another pension fund or your manager, or maybe someone else like a consultant that has been mentioned. Any wish you have to make the partnerships even stronger?
I think the objective of this initiative is to create a model that either can grow or can be replicated. So my wish is to make it visible and to convince other investors to move into that direction. And again, we all have to collaborate. So we think partnering with the government and asset owners is the right path. So I hope this is going to be much more visible. I also have a hope is to bring on board other experts with a different angle, and definitely the GIN, but also ethos. I think it's so important to have the big actors in Switzerland that help us to improve the concept. Thank you.
Thank you. Joaquin?
Well, I can only sell my house, no? I mean, yeah, again, EIF is I think it's a big platform. It's a big team. We see a lot of things. My colleagues on the primaries, they like to say that they see 95% of what happens in the market. I don't know if, no, sorry, 99. I don't know if it's 99, but even if it's only 80%, I would say that there is not a new investment proposal, and now that we're talking impact, there's not a new impact investment proposal that would be in line with the strategy of the EIF that doesn't knock on the door of the EIF. So I think that we are able to put this whole franchise, this whole platform to the benefit of this project. Again, it's 75, 80 investment professionals across the entire spectrum of private equity, and I think that makes us quite unique. So
you wish is that the other funds that you haven't seen, the missing 1% will knock on your door going forward, right?
We'll see.
Vincent, please.
Sorry again not for being here today, so thank you also for the discussion. So no, I guess the partnership is key. We've seen that with the active ownership strategy we have developed at Ethos 25 years ago, 2 pension funds, 240. So that gives us a leverage at general meetings to push companies, large listed companies, towards a more ambitious climate plan. We still see a lot of those climate transition plan or those net zero pledge unrealistic. Counting a lot on financing carbon wells, and so I think we absolutely definitely need more. Solution exists, but they need more financing. And at one point, I guess we will realize that some of those large cap still have some greenwashing strategy. Grégoire mentioned Coca, but many others. And finally, supporting the real economy will go through impact investing. So I'm still hopeful that we will reach more and more pension funds being courageous to go in that direction. Not courageous, but because I think it should be already. But yeah, lifting the last barriers.
Thank you. I think that was the perfect word for this session. So thank you, the panelists, Grégoire, Joaquin, and Vincent, for being present today, and thank you for the audience as well.
Thank you.
Thank you.
Bye-bye. Thank you.